大家好，欢迎来到 YouTube 大佬透镜。我们用一张 PPT 解读财经大咖的深度分析。今天是2025年10月16日，我们来分享达利奥接受彭博社的一个访谈。访谈涉及很多热点，聊了他一直以来的分析框架，还谈到了黄金投资策略。这次我们用了2张 PPT， 第一页是为对达利奥不熟悉的朋友准备的。当然，基本上每次访谈他都会阐述一次他的核心思想。他认为有5大周期性力量在推动世界局势的发展和演进，而这也指导了他的投资决策。非常熟悉他的朋友可以直接跳过，进入下一张 PPT。 第一大力量，债务、货币、经济周期。信用相当于经济循环系统，债务若能产生足够收入则健康，否则债务成本过高会挤压其他支出，导致经济问题。第二，财富与价值分化。经济不平等和价值观差异导致政治极化，左右两派矛盾加剧，可能削弱民主机制。历史上如1930年代，甚至导致民主国家转向独裁。国际地缘政治周期，新兴大国如中国挑战现有霸权如美国，引发全球秩序重塑。第四，自然因素，干旱、洪水、疫情等自然灾害对经济和社会的破坏力甚至超过战争。气候变化是当前的重要变量。第五，技术进步，新技术的发明如 AI 推动生产力提升和生活水平提高，是长期经济增长的关键。下面是访谈的要点。历史经验，战后建立的多边机构如联合国 IMF 作用下降，全球进入更加分裂的格局。当前局势类似1930年代，债务危机、政治极化、地缘冲突和货币体系崩溃交织，全球秩序可能重塑。结构性问题，美国顶层 1% 的人拥有大量流动性和财富，底层的 60% 面临经济压力。降息可能刺激经济，但加剧债务失衡，货币政策难以解决结构性问题。黄金是第2大储备货币，仅次于美元。在债务过高、货币贬值环境下，黄金作为非信用依赖的资产更具吸引力。黄金是投资组合中的有效分散化资产，其在信用资产下跌时表现优异，建议战略资产配置中占比约 15%。 达利奥倾向减少债券等债务资产配置，增加黄金比重。中美投资比较，美国市场规模大，流动性强，但估值偏高；中国市场估值较低，但资本流动性和政策风险较高。达利奥更倾向投资美国。大佬透镜认为，中国资本流动性和政策风险是内地券商不敢说的，这就是我们关注华尔街大佬和英文访谈的重要性。泡沫担忧， AI 相关市场存在泡沫迹象，类似历史上的郁金香热或2000年互联网泡沫，但技术进步的长期潜力仍然存在。一句话，短期可能有点问题，但是长期还是不错。好，要点我们就分享到这里，接下来是访谈的完整版。这里是 YouTube 大佬透镜，我们致力于过滤垃圾信息，挖掘优质内容，欢迎订阅、转发、常来。坚持用多元化甚至互相冲突的信息给自己洗脑，所谓兼听则明。
Thank you so much for being here. I want to start with these 5 forces that you see right now that are affecting markets that are important to understand in order to understand where we are. Could you just talk a little bit about what those forces are?
Sure. Through history and now, there are 5 big forces that are interrelated and generally transpire in cycles as I described. And we know they exist because everything that we are going to talk about will fall into one of those categories. That is the debt money economy cycle, meaning credit is buying power. You give buying power to entities like it's like the circulatory system. You give credit, and if that credit produces, it'll produce debt. But if it produces an income that is good enough to pay the debt, it's a healthy system. But when it produces more debt and more debt service payments That squeezes out the spending, and that produces a problem, and then there's a supply-demand problem that has to, and then there are economic problems. Okay, that's one cycle. The second cycle related to that, because money and wealth have political and social effects, is that there becomes big differences in wealth and values. And so when there are big differences in wealth and values, and the people feel that the system isn't working for them, you see greater political polarity between the left and the right. It becomes more the hard left and the hard right. And those become irreconcilable differences that are not easily solved through the usual means of operating that way, such as democracies. During the 30s, for example, 4 major democracies chose to be autocracies during those periods. The third is the international geopolitical cycle. In other words, of a rising power challenging existing powers, and the same dominance of the dominant power fades relative to other powers, and also the order then gets challenged, and we're certainly going through that. The fourth factor throughout history has been acts of nature. Droughts, floods, and pandemics have actually killed more people than wars, and actually led to more ends of the previously mentioned cycles than anything else. So nature, and certainly nature, climate change and the like, is a big force. And then fifth, through history, are man's learnings of particularly developments of new technologies. The developments of new technologies is what has raised living standards over time, which you can see in terms of life expectancies and per capita GDP. And of course, the development of new technologies now is a very important influence. So those 5 factors have evolved. Those are the main 5 factors. Anything we'll talk about will be under one of those. And of course, the interrelationships between them is important.
It seems like we're at the cross-section of a pretty transformative moment then, because it's this cross-section of all of these things, whether it's the AI aspect, the technological overlay, the monetary debt aspect of it with respect to the debt and deficit. Can you put into perspective the fact that this has been building up over time? Where do the tariffs and some of the trade disputes of today fit into that? Do they help sort of alleviate some of these imbalances? Do they exacerbate them? Are they a symptom of them? How do you understand sort of that aspect of policy right now? Well,
first of all, there are great imbalances that have to be rectified given this set of circumstances. 3 major types, which relate to trade, but they also relate to capital. The first is that the dynamic by which Chinese export to the United States items that are cost effective and Americans buy them, and then they send the money back, and the Chinese earn the money and take that money and invest in bonds, has created a unsustainable dynamic, because as we're living in this environment related to the next 2 items, where those 2 countries can be in conflict, military conflict, there necessarily has to be insecurities on both parties. The Chinese having an insecurity of whether they're actually going to be able to turn their credit into goods and services. In other words, there's no purpose of holding a bond or an asset unless you can then sell it and get money and buy things. And when that dynamic works the other way, it's quite painful for the debtor to have to pay back in real stuff. And then in a geopolitical conflict, that's a problem. And then, of course, and then in this environment of conflict, that's also the problem of, it's worsened, because in wars in prior times, or even with Russia, then there were freezing of assets, and there could always be that kind of issue. So that's a consideration. And then, of course, there's the loss of manufacturing. And the loss of manufacturing in the United States, has 2 problems, which are that it's connected to self-sustaining. You have to be able to be in a risky world. You have to be able to produce what you need. So you need to be capable in manufacturing certain items. And then also the wealth, the loss of the middle class has a lot to do with the loss of manufacturing. So for those reasons, that imbalance, that let's call it trade and capital count imbalance, it's both a trade issue and a capital issue. And raising tariffs is a way of dealing with that. Through history, tariffs really have been more of a tax than other forms of taxes, going way back. And they bring in tax revenue. So, they'll probably bring in somewhere between 300 million and 500 million a year, something like that. And so that's a consideration. So that's the mechanics about what's happening.
I just wonder if you think that goes toward alleviating concerns about debt insustainability, certainly in the United States, given that there will be those revenues.
Yeah, right. It is a source of revenue, and it will diminish that. However, the economics, it's small by comparison to the gap. So, as I said, the mechanics of the debt situation are really have a few components. The first is that when debt service payments add up, they squeeze out other spending. And so that can create the equivalent of an economic heart attack. The second is there's a supply-demand issue. In other words, a deficit requires debt sale. And so we have a lot of debt sales, and there's lessening demand for that. And then there are the central bank playing a role. So what we have now is, think of it as a big company or an individual, except the main difference between a country, and an individual or a company and a government is that the government can print money. So that's the basics. But figure it this way. The United States, here are the numbers. The United States will this year spend about $7 trillion, and it'll take in about $5 trillion. So that means it's spending 40% more than it is taking in. Because it has run deficits and sold a lot of debt, the total debt is about 6 times the total amount of money coming in, and we're seeing those debt service payments squeeze that out. And as a result of what the projections are, it's likely that those deficits will then produce lots of bond sales, which will compound it. When you get into the point in the cycle where debt is needed to pay debt and compounds, it becomes a problem. It becomes a problem also for the central banks, because the central banks, by the way, this is not just an American problem, this is a world problem. The central banks themselves own the debt. And so, and they lose money on the debt. And so when they're losing money on the debt, and they have asset liability problems, then they also not only have to monetize essentially the government's debt, but they also have to monetize theirs. And those are the characteristics that produce a deterioration in the monetary order. And that's why what you're seeing. You're seeing a dynamic of why countries, for example, are letting their reserves or their assets in bonds and so on go down, and they're acquiring and have been acquiring gold, for example. So gold is a currency. We think of currencies as being the major fiat currency, but gold is a currency. It's the second largest reserve currency. And so you're seeing changes in the monetary order that are reflecting those things, somewhat like happened in the early 70s.
Ken Griffin yesterday of Citadel said that he sees gold as more of a safe haven right now than the dollar. Do you agree?
Oh, certainly. I mean, I think, tell you a story. I've been trading markets since I was a kid, and between my college year and going to graduate school in the summer of August 1971. I was clerking on the floor of the New York Stock Exchange, and I followed markets. And on Sunday night, Paul Volcker and then President Nixon, really, it was President Nixon, delivered the message that you're not going to get your money. Gold was money then. So we viewed things differently. You know, like money, fiat money as we think about it today, was like checks in a checkbook so that you can go get your gold. And we looked at things through a gold lens. I walked on the floor of the stock exchange. I thought, this is a big crisis because you're not going to get your money. People are not. And the stock market, I thought it was going to go down a lot. Stock market went up a lot. And I went and I studied history. That's, by the way, why I study history. So I studied history, and I found out the exact same thing happened in March 1933 with Roosevelt getting on the radio and doing the exact same thing. In other words, devaluing money, okay? In other words, so when we're looking at the world now, we look at it through our currency lens. You know, we think things go up or down when we're measuring it in our currency. But in reality, the currency goes up and down. And so as we start to think about that, okay, think about what's happening. Yes, it's a currency, it's an alternative currency, it's not a fiat currency.
So do you think that it actually makes perfect sense that the stock market is hitting record high after record high at the same time that gold is hitting record high after record high?
Yes, yes. It's very much like the early 70s, and then the question, because what do you put your money in? Okay, of course the stock market has, we can't speak about the stock market as a whole, of course, because the stock market is so bifurcated, you know, and the world stock markets are so bifurcated. But yes, that is the dynamic. It depreciates the value of money, and then it costs, because everybody, it's all about a storehold of wealth. What is your storehold of wealth? What's it going to be? A currency should be a medium of exchange and a storehold of wealth. But when you have so much debt, you know, that debt is money and money's debt. I mean, debt is money, meaning when you hold debt, you're holding a promise to receive money. And when I say money is debt, when you're holding money, you're putting it in a debt instrument. And so for those reasons, when you have such a supply of debt and debt instruments, and it's not an effective storehold of wealth, it's natural to go to an alternative storehold of wealth, which is why we're going to harder currencies. And, you know, and of course, gold is the most fundamental of those, not only because of the many years, but even there, it's, you know, as they say, it's the only asset that somebody can hold that you don't have to depend on somebody else to paying you money for it.
At a time of incredible uncertainty, but also potentially incredible opportunity, you were talking about the technological advancements. Can you give a sense of how you're thinking about allocations with gold versus bonds versus US versus international versus some sort of leveraging to this story of technological development?
Well, I think, first of all, in an asset allocation mix, the first thing you have to do is create your neutral portfolio. What's your balance? You know, what's your beta mix? To your strategic asset allocation, if you don't have a view of the markets to make tactical moves. And then you have to think, how do you make tactical moves? Who's going to make those? Because tactical moves are a zero-sum game. You have to beat the other person who's doing it. On the strategic asset allocation mix, before I get into the tactical, though I've expressed my views on the tactical of gold relative to bonds, I think you have to create a very good balanced portfolio. How you do that can take a long session, but I think you have to think of that not in nominal terms, but in real terms. So in other words, when you're thinking, you're doing your asset allocation, what is going to protect your real after-tax returns? So you create that optimal mix. Gold is a very excellent diversifier of the portfolio. So if you were to look at, just from the strategic asset allocation mix perspective, you would probably have something like, as the optimal mix, something like 15% of your portfolio in gold, because of the fact that if you didn't even have a tactical, because it is the one asset that does very well when the typical parts of your portfolio go down, because the typical parts of your portfolio are also so credit dependent. So anyway, I think all of this means that there should be some piece in that of gold. If I'm making tactical bets, I don't like debt assets per se. And I would say I don't like debt assets per se, not just government debt assets, but also if you're looking, let's say, at credit or private credit, and you look at where the credit spreads are very, very low. And so for those various reasons, my tilts would be away from those things.
And toward gold.
But again, yes, so more than would be a normal asset allocation mix. But I think you have to also say, start with what is a real dollar, if you're a dollar investor, a real return asset that you're going to hold as part of that portfolio. The most of the system is dependent on credit. Equities and everything is dependent on credit. You change credit and then all sorts of things happen. And so it's an effective diversifier as well as probably the timing seems good.
Going to the 5 tenets that you were talking about, given the imbalances in the deficit, in the debt load, and the amount that people are going to have to sell, governments are going to have to sell, do you think it's appropriate for the Fed to be cutting rates right now?
I think the picture on cutting rates is slightly mixed. And it has to do with the split in the economy, and it has to do with split in capital markets, which means you're trying to look at the economy as a whole. But what you have is in certain sections of the economy, you have an enormous amount of liquidity, enormous amount of wealth. Things are like if you're in the top 1% of anything, or which is the top 1% of the income earners, the top 1% of the stocks, and AI, and so on and so forth. Wow, there's a tremendous amount of liquidity and fantastic. And so you would say, if anything, you'd worry more about the bubble and how you start to pull the punch bowl, that kind of thing. But we have a very diverse economy. So if you're looking at, let's say, the bottom 60% of the population and the conditions of the bottom 60% of the bottom population and labor markets and so on, then you have a very, very different issue. I don't think monetary policy at all is going to be able to do that. I think that there's a strong situation where, the natural instinct is if things aren't exactly like I would like and I'd like to make them better, I should ease monetary policy. Okay, so I mean that's now, we've learned that, right? Because every time you do that and then things go up and people are happy and so on. But there's a cost in doing that, right? The cost in doing that is that there's, one man's debts are another man's assets. And so when you artificially lower the interest rate so that it is not attractive, in a sense, to hold as an asset, and it's very attractive to borrow and buy things, that creates an imbalance. So I think that I think that discipline is not something that anybody seems to want, and yet I think it's needed. So when I think about the monetary policy and so on, I think not much, if any, but I also think it's not really dealing with the whole so well because of the disparity in the parts.
Going back to the video that you showed first, you're talking about these 250-year cycles and then 10 to 20-year periods where there's a transition of a power from one to another nation. And I just wonder if you see things the same way this time, because it seems like globally there are the same issues everywhere in terms of these imbalances and in terms of the deficit, in terms of nobody really wanting to take the punch bowl away at a time of increasing distress in certain pockets. Do you think it's different?
I think, and just to be clear, that's the whole cycle of the Great Cycle. In there are breakdowns of orders, right? So 1944, we had the breakdown of the monetary order. We had another breakdown in 1971, all right? So 1945, we had the breakdown of most countries' political orders and most countries' geopolitical order, right? So we have those cycles, which are part of then the overall greater cycle, are worth keeping in mind. So they look a lot alike to me. So when I look at it and I look at the 30s, I think there's a lot to be learned about that particular dynamic. I think one shouldn't just believe a cycle is going to follow. I think it's like almost like a life cycle. Each person's life cycle is somewhat different, and it's caused by symptoms and conditions that could be measured. So you can look at the economy. You can look at the numbers themselves and see the health indicators. And that's what I did in the books I wrote and so on. So you can look at them directly. You can see how much, like a doctor taking, a CAT scan of the circulatory system. You could see how it's squeezing out. You can see the supply demand. You can see this dynamic happening. You can see it politically. You can see it globally. So you could see those breakdowns, okay? You have to then put them in the context, I think, of what the process is. What does a country do when it doesn't have enough money? Okay, there are a limited number of things. In order to see that, you can go back in history and get some understanding and also see what's going on now. So I think it's very, very similar to that. Just, to me, these all look like watching the same movie over and over again, except people use different technologies and they have different clothes and so on, and there are different people. But they look so much alike, so I think that this is pretty much looking like the typical process.
So everyone's asking, how does it end, right? Everyone wants to know how the book is going to end, how the movie is going to end. One thing that you've been talking about is how China has been taking over in a significant way, that the economy there has been growing tremendously. I just wonder whether some of the rebalancing and the rejiggering of the trade flows in the world are stymieing that progress, or whether they're a speed bump, or how that you see that fitting into the trajectory that you've been witnessing over the past 10 years.
Well, China has a number of problems that he has to deal with, which I'll touch on. However, since I started to go to China, which was 1984, and I went first for curiosity, and then because it was so interesting and I liked the relationship. Per capita incomes increased by 28 times. Life expectancies increased by 10 years and so on. It's done and remarkable. But it now has very significant problems. I'll quickly take you through 4 or 5 of those. On its debt problems, its debts are all denominated in its own currencies and among Chinese, mostly speaking, but it needs a giant debt restructuring. The difficult one is the local governments, because the local governments in China account for more of the economy, and they're broke. The model, they were selling off land, earning money from land sales, and borrowing money to produce high production. And so not only do they have a debt, but they have a model for those local governments that is not an economic model. In other words, what do you do with businesses that don't work, that don't have a profit? And related to this is the rationing system, that they don't have a profit system. They've gone really mostly after quantity. So and the quantity, how do I maximize the quantity of production? Forgetting about the profitability of that. So when you have that, then you have the dynamic that they're now describing, which is now called involution, which is the fact of overproduction doing harm to the economy. That's going to require a big restructuring, like these big restructurings go, similar to what they did in the 90s. Zhu Runji was the vice premier and premier at the time who did this. But the way they go is you have to pick which companies are going to stay, and which go on the auction block, and which get restructured, and so on. Otherwise, they're going to have the problem similar to China, okay? Because Japan. Japan had the same thing, too much debt, but it was a surplus country, and the debt was in its currency, and they had locals. But you have to do that restructuring. So there's that. And then there's a number of things that we won't have, but certainly the world markets have changed. China produces manufactured goods, is dominant. 32% of the world's manufactured goods come from China. That's more than the United States, Japan, and Germany combined. And now their markets are being closed to them and so on. So they have to go to the third world. There are a number of these types of issues having to do with a pension system, an income tax system, and so on, that if they don't deal with well, and they're very difficult to deal with well, that'll be a burden on China, while at the same time, it's of course doing amazing innovations in a number of ways that are government directed. So I don't want to just say that it has those burdens, and it has a lot of really powerful thinking and quantity of engineers, and what can be done is quite something. They're more advanced in the use of AI for applications than the United States is, for example, actually using AI and so on. Anyway, that's too long of an answer, probably.
Would you rather invest in China than the U.S.?
No, I'm not. I think when I think about it, I think how much do I allocate to each market, right? And I think of that first as a strategic asset allocation. I look at things like what's the size of the market capitalization, how is it easy for me to get my money in and out of the country, how attractive are they, and so on. So there's a greater amount that I'm investing in the United States than I'm investing in China. I think, and both have their challenges and their benefits. In the United States, it depends what market we're talking about, but if we're talking about a lot of the market, it's quite expensive. And the nature of the flows are concerning, and the nature of a number of circumstances are concerning. If I'm looking at China, it's a different thing. It's relatively inexpensive, some of those assets, but at the same time, capital flows and other issues also make it a problem. So I think of, I have my allocations to each, much greater in the United States than it is in China, and then I move tactically within those. That's how I work.
You've mentioned really tight credit spreads. You've mentioned some of the flows concerning. There have been a lot of discussions around bubble-icious conditions in the AI space in particular, in that slice of the market. Do you see that there is some sort of excess building? When you look at history and how this has always played out, whether it's a dot-com bubble or whether it's the tulips over in Amsterdam, I mean, is this something that feels frothy to you?
Yes, this is something that feels frothy to me.
How do you see
That's a
that
straight
evolving?
answer to your
That is
question.
fantastic. I think that was brilliant. I wonder, how do you see it evolving? I mean, because there is this great promise, right? It's sort of the idea that the internet did come to fruition and change the world. AI might change the world, but
it certainly will. But if you're asking history, at each of the times, the greatest technological revolutions were taking place during those times. In other words, the late 20s, for example, there were more patents, more inventions in the world, and so on. And if you could take 2000 or those types of period, a lot of them are dependent. There's an interdependency between the capital markets and these in terms of funding and those types of things. So we have to look at valuations too, right? I would say in terms of, let's say, AI valuations and so on, I think it's more in the areas of applications than let's say, the superscalers themselves. I wouldn't want to be short the superscalers. But if I'm thinking about it's going to be in the users. Either the users of those technologies becoming more effective, and so their profits will be better and so on, or those who will provide the platforms for the effective use of those. I think that's an area of greater opportunity.
You mentioned something about China that I think is a subject of huge debate in the United States, which is the way that they've sponsored certain industries and certain development of technologies in the AI space and beyond. And I wonder if you think...
And by the way, we're doing that too, right?
That's what I wanted to go to. The idea that the United States is now taking a stake in lithium companies, in Intel, and a whole host of others, and the sort of cobbled together sovereign wealth fund that we're learning about in real time. And I just wonder, do you think that is the right approach for a country to take at this moment?
At this moment, I again want to compare it with the 1930s, because you have to look at the times and what it's like, right? So this is a period of great conflict. And if you take such periods of great conflict, the country often needs a direction. You know, it can't be just consumer goods, rich people then buying expensive things like handbags or something, you know. So it needs a direction. If you're looking at things like data centers, and what does it mean for AI, and what does it mean in many ways, in order to be competitive, there needs to be much more guidance, because it just is not going to be adequate by itself. So yes, I think under these types of circumstances, there needs to be that. The question is whether that is done wastefully or productively, right? The problem with governments, generally speaking, is it's done wastefully. So you have state-owned enterprises or state-controlled and that, and people in Washington are not usually really good at this type of stuff, resource allocation. The question is how the balance exists. But yes, I think at these types of times, there needs to be more of that, and you hope that that's done well.
You've mentioned 1930s several times, and that this is a time of conflict. And we know how that movie ended. Is that kind of the parallel that you see this right now?
I think it could. There's a certain dynamic that makes it get worse and worse, you know? So there's the debt dynamic that we're talking about, but there's also, let's say, the internal political dynamic. Do we see people coming, both sides, being able to work together for results, and that there's going to be votes that people believe, and they believe the system is going to be fair for them, so that if they lose, they accept losing because they believe the system is fair and so on. You know, history shows that that's not likely, and that things can worsen because people then, you know, in history it can get bad. I don't know, one side shoots another side, and who knows where it is. You know, one would hope that there would be sort of a strong middle that would bring for most people, and that you can get back to a system that's fair. But I think that that's a difficult thing to do. I think the world order, the changing world order, we've gone from a multilateral world order. In other words, it was the American model that there's a United Nations, a World Court, a World Health Organization, a World Trade Organization, an IMF, a World Bank, and all of those world, so that there is sort of an attempt to bring rules and systems into place that are multilateral. I think that's over. That's largely over. I don't think we're not likely to go back to those types of things. So I don't think, I think we have to instead worry about not having such a bad fight with each other, or a financial crisis, that we make things worse than they are. But you're asking me as a man who actually has to bet on this and has to be as accurate as I can. I mean, like, hope is not a strategy. So when you ask me, I say I really hope that that's not the case. But if you look at history and you look at the dynamics, there's more the movement toward these things being resolved in the form of conflicts that we've seen in the past.
On that uplifting note, we're out of time. Ray Dalio, it has been absolutely my pleasure to speak with you. Thank you so much for being here. Really wonderful.